options traders would consider hedging their position just like an underlying trader would consider hedging their position as well. So if you're long a call, you have the risk of losing your premium. So that's going to happen if the underlying dips down or if timed expiration decreases and theta comes off, your premium decays, or volatility is coming off, things of that nature. We'll discuss theta and vega later on in implied volatility. What's important to know is that hedging your long call can be done with the underlying by shorting the underlying in a 1-to-1 ratio, or shorting the underlying at a ratio equal to the delta. So say you're long a 30 delta call, you might sell 30 shares of stock against it. That's safer than selling 100 shares of stock against your long call, for the fact that if we have a move to the upside and that's why you bought the long call, you're at risk to lose more money by being short 100 shares than being short 30 shares. So I would suggest, if you're going to hedge your long call with an underlying, you're going to want to start off doing so with the delta ratio. If you decide to sell a call against your long call, you're most likely going to be selling a further out of the money call, a less expensive call. That would be putting on a vertical spread, a long vertical spread. Maybe you're going to hedge it in a different expiration. You're going to be, maybe doing a long call spread or a short long call time spread or a short call time spread. Possibly you're going to do a diagonal. We've discussed all of those things to consider. Time is a big factor in determining what type of spread you're going to be putting on. If you want to do a horizontal, if you just want to do one within the same month, that's up to the trader. Now, when you're hedging with options, directional risk is going to be offset by trading a more in-the-money call. But at that point, you got to consider, like, do you really want to still be long this call? The fact of the matter is, if you want to stay in a long call position, you're going to want to probably just offset the premium or offset some of your directional risk, and that's going to be achieved through selling one of those out of the money calls within the same expiration, or maybe shorting some stock against it, even possibly by buying an out of the money put that has the same delta. There's many different ways to hedge your long call position. It's just a matter if you want to put on more risk, and if you do, well, that risk is going to be maybe in the form of premium by buying a put against your long call, or risk in selling shares against your call and those shares going against you. So that's something you're going to develop over time. Your style of hedging is going to develop, especially in the beginning of your trading career and the beginning of your hedging career.